Property markets have had a lot to contend with this year, haven't they? It started with floods at the beginning of the year, then the fright of the geopolitical problems overseas and what that could mean for us. Then there was the continual conveyor belt of negative news in the media about inflation, about rising interest rates, and the possibility of a housing market crash. And now they seem to have experienced a winter chill. So to understand what's happening around the ground in our property markets, I'm looking forward to the My Housing Market monthly update from Dr. Andrew Wilson, Australia's leading housing economist. Hi, Andrew.
Yes, hello, Michael. And it's exciting to be able to be first with the news for what's happened with house prices over the month. And of course, for the middle months of the quarter, we look at asking prices, and for the full quarters, we look at sale prices. We can look at those monthly changes in asking prices, which gives us a similar, reasonable insight into what's happening on the ground.
Well, it gives an indication of how vendors feel. And I know, looking back in the past, it's actually been a great leading indicator of what the end result of the sales are.
Yes, it is. And positives about looking at listings data, Michael, is it gives us the whole market rather than with sales data. We have to wait for some time before we get all the sales results. So they tend to be a little bit more backward looking, whereas listings data is telling us exactly what's happening here and now.
So what have you found for the month of July, Andrew?
Well, no surprise, Michael. We know that markets have been easing given the spectacular results of the last year or so, particularly in Melbourne and Sydney. Affordability barriers have dragged buyers out of the market because they don't have the capacity to keep up with what were spectacular prices growth last year. And of course, the double whammies come along with higher interest rates, which has affected confidence, and a lot of negative media around. And the triple whammy is that it's winter, and this is always a time of distracted buyer and seller activity anyway. But the figures certainly validate that. We've seen again all capital cities falling in terms of median asking prices for houses, with the exception of Adelaide, which has continued to increase over the month, but it did fall away over June. So it's a bit of a consolidation of the 2 months, but all those other capital city markets are down. No surprise that Sydney is leading the charge downwards. Of course, it led the charge upwards. So we, I guess, expect to see a consolidation of what was that strong prices growth over the year in terms of an adjustment, and adding to the other factors, as we said, which are influencing fewer buyers and sellers in the market. So Sydney was down by 2.7% over the month, Michael, which was certainly a steeper decline than what was recorded over June. Interesting points from the capital city results, and these are for the 5 major capitals. We saw that Adelaide was the exception in terms of growth over the month, but Melbourne was down by just 0.5% over the month. And I think that adds to other indicators that the Melbourne market, while certainly easing, is not easing at the same rate, particularly as Sydney. And I think we've seen that with auction clearance rates in Melbourne have just been holding the line over the month of July. The other interesting point, I think, Michael, was we finally started to see the Brisbane market easing. It's had quite remarkable growth over the past year. In fact, it became the top performer in terms of annual prices growth. But now, obviously, those affordability barriers are starting to impact buyer activity in Brisbane. I mean, the median price for a house in Brisbane had exceeded $800,000. And the difference between Sydney and Brisbane and Melbourne house prices had constrained. Brisbane was catching up with Melbourne and Sydney. Still a long way to go, but it was certainly catching up. So, at the end of the day, that meant that affordability would eventually start to push down asking prices in the Brisbane market. And we've seen that with Brisbane down by 1.9% over the month. It was down also over June, but certainly not as much. So again, it's those spectacular boom markets finally impacting affordability. And of course, the other issues with affordability are higher interest rates that are also starting to bite now. So that was the position with asking house prices over July, Michael. But when we look at the annual results, they're still very strong. Over the past year, prices are still well ahead of where they were a year ago. Now, the other thing that we've tracked, Michael, is the unit market. And interestingly enough, the unit market hasn't had the same negative results. So asking prices for units were generally higher over July compared to June. The exception was Sydney, where asking prices were down just marginally by 0.7%, Michael, and Perth also down marginally by 0.5%. So the unit market, perhaps reflecting affordability, is holding at the moment. And we have a similar result with the annual result for the unit market, with Sydney probably the underperformer there, with higher by just 0.5% for units over the past year. But Brisbane and Adelaide still have reported strong growth over the past year for unit, although not as strong as houses. No surprise, I guess, in terms of the overall easing of asking prices. I think the outlook is for more of the same, and confidence is the key, whether we start to see a revival coming through in August, as we would normally expect as the spring selling season approaches.
Now, I know one of the things that My Housing Market also measures is how many houses are listed for sale, and that gives an indication of what's ahead as well. What have you found there, Andrew?
Well, certainly there's a correlation, Michael, between what the data is showing us in terms of asking prices and asking price changes and the number of properties that are currently listed for sale in the market. No surprise, we've seen a big increase in Melbourne and Sydney over the past year for both a number of properties advertised for sale for both houses and units. And of course, a couple of factors there. We were in that lockdown environment a year ago, which was constraining the number of properties for sale. But of course, the other point is we have fewer buyers out there. Properties are taking longer to sell now as the market starts to adjust. So no surprise there that listing numbers are significantly higher now in Melbourne and Sydney than where they were a year ago. But the reverse of that is that Brisbane and Adelaide listing numbers are well down on where they were a year ago. So it's all about the competition for property there. And it still reflects in that Brisbane and Adelaide market what notionally is still a seller's market. Law of supply and demand, we're seeing a lot more supply now in the market for Melbourne and Sydney. So that's acting to provide more competition amongst sellers and certainly a lot more choices for buyers.
On the other hand, the rental markets are very tight. So I'm looking forward to the upcoming My Housing Market rental report, because I think we're again going to find there's such a shortage of properties that rents are moving up, Andrew.
Again, rental markets and housing markets are moving in opposite directions at the moment.
And just to finish off, some people are going to say, I told you so. We're going to get a crash. If you multiply Sydney's fall by 12, they're going to drop 30%. Is that really going to happen, Andrew?
Well, as I said, we're now looking for a revival. As we've discussed, quite often, Michael, the positives are certainly outweighing the negatives, all but one factor, and that is confidence. And when confidence starts to return to the market, as it should do sooner rather than later, because of the overwhelming positives of demand over supply, and of course, the fact that our economy now is looking to be a leader in terms of the position to offset what are very high inflation numbers.
Well, we'll catch up in a couple of days for our regular weekly Property Insider Chat, where we'll go into more detail about that. But I agree with you that at the moment, consumer confidence in many areas is what's holding the economy back. But that's what the Reserve Bank's wanting. But eventually consumers are going to realise, hey, interest rates have peaked. Inflation has peaked and it's under control. And then fear is going to be overtaken by the other emotion that we get when we talk about property, greed. And the market is just doing what it always does, Andrew.
And that's right. And every interest rate increase, Michael, is a potential interest rate decrease down the track. And when we clearly have demand so far ahead of supply, and that's not an opinion, that's clearly reflected in the factual evidence of data. And we just, as we've suggested, just have to look at the plight of tenants in the rental market to validate that. But eventually that means that we will release all the pent-up demand that we're currently creating. And that's what we've always seen in these cycles, that lower rates translate into release of pent-up demand for higher prices, but certainly higher rates create that pent-up demand where buyers and sellers sit on their hands. And that's why we don't typically see the steep declines in prices that many are predicting at the moment.
Well, I look forward to catching up in a couple of days for a weekly regular Property Insider Chat. So much to talk about with interest rates, inflation, what our new Treasurer had to say. Thanks for doing this in between one, though, so that we're ahead of the others, fully understanding what's happening on the ground in our property markets, Andrew.
Yes, Michael, thanks for that.